Hey everybody, Marty Mazur. Good morning. It's the 19th of October, 2016. I'm thinking this morning that I want to share with you what the market is sharing with me, if you will, about the prospects going forward. And I say it that way, folks, because I want you to understand or remind you maybe that the players in the market, traders and investors collectively, short-term, long-term, et cetera, I'm going to tell you that they are not political when it comes to investing. Meaning, as individuals, just about everybody has a political view or a political bent. But when it comes to putting money to work, particularly the institutional investors who need to make money year in and year out, they don't, but if they could, they would. They are essentially there to make money, not to invest based on their political preferences. So the market then becomes a discounting mechanism on what the world collectively thinks about the prospects for stocks, the economy, et cetera, going forward. So the chart you have in front of you, what I'm going to do is I'm going to start with the defensive sectors and suggest that when the world collectively of investors fears a coming recession, then you tend to see money flow to the defensive sectors like utilities, which is the first index you have in front of you, or it's a ETF that tracks the S&P Utilities Index. This chart shows you the relative performance of utilities relative to the S&P 500. So as you can see, since June and then recently, a big drop recently, and then we have had a move up, and this has been on a little bit weaker economic data. But the trend certainly since mid-year has been lower. So this is the market, at least as it relates to utility stocks, not worrying too much about the world coming to an end or things getting really, really bad and people, of course, having to keep the lights on. Therefore, let's invest in an area that we know people are going to have to continue to spend money in. Another one would be consumer staples, your companies that you got to buy their products to stay alive. So when people aren't investing or buying, I should say, cars and computers, well, Kraft still sells a lot of mac and cheese. Take a look at the relative performance of consumer staples. Certainly nothing that is suggesting or predicting doom and gloom to come. Healthcare would be another one. Other than the political risk, it tends to be a very defensive place to go because, again, people, regardless of whether they have any money, if they got a bad stomach ache or they need medical attention, they're going to get it, and somehow the system will get paid. So healthcare tends to be a defensive sector that is actually going in a direction that does not suggest that there's a great deal of doom and gloom, at least in the eyes of the market, to come. Then we get to some of the more cyclical things like financials. You can see financial stocks bottomed back in June, and they're finally beginning to show signs of life. This would be a predictor, if you will, that the economy is going to do better. People will continue to borrow, but interest rates will go up along the way, which they should in that environment. And banks will have a higher net interest margin and therefore have better profits. Commodities have really bounced since early in the year and have kind of been hanging in there and kind of sloped a little bit since then. This is a global commodity index, so if commodity prices are going up, that suggests higher demand relative to supply. Here's energy. You can see where energy is finally beginning to come back. Energy, though, has been, I think, more of a supply issue than a lack of demand issue, as I've talked about a lot, not as much lately, but the world has been awash with actually record inventories of oil. But recently, OPEC had struck a deal where they're going to limit some production and so forth. We'll see if that comes to pass. But amid a somewhat of a supply destruction because of low oil prices, they've begun to bounce back. So we'll see how that continues to go. But higher oil prices tends to be an indicator of a better economy. Materials have been all over the place. You can see recently they bounced in a pretty nice way. I'm actually looking for some more infrastructure, or I should say some infrastructure investment in the U.S. in the coming 2 years. They're talking about a lot in Japan and other places, so I'm very interested in materials going forward. You can see they've had a pretty good run off the bottom, but come back a little bit here of late. A lot of that, again, there is some real dollar sensitivity, as there is with other commodities as well. But in that materials space, I'm looking at companies that would benefit from big infrastructure build outs, and I think that has something to do with that little notch higher there. Consumer discretionary has had a stellar couple of years. Valuations got a little high. There's been some real profit taking this year, so they have not had a good year. Again, in client meetings, some of you may recall I've been talking about, or I was earlier in the year, the valuations are a little suspect there. Notice they're beginning to come back a little bit. This is something that would do better in a better economy, but this trend since the middle of the year until recently would not suggest, at least in that sector, that it's anticipating great things, but certainly not the end of the world either, if you look at it more recently. And then we have industrials. Industrials have had a pretty good year off the bottom, been moving in a real sideways, maybe a consolidation pattern. You see it's beginning to trend higher. Again, I'm looking at some industrial companies that relate to that infrastructure story as well. And then lastly, technology, maybe one of the most cyclical industries, as you can see from before mid-year, huge bounce in technology stocks. You can see technology is doing very well and continues to do well. This is not a harbinger of terrible things to come in terms of the economy, at least from the market's perspective. Let's look at a couple other things. Another way a real good indicator, I should say, of stress in the economy is what's called the high yield credit spread. High yield bonds or junk bonds, they have lower ratings, and when there's a lot of fear about an economy that's about to contract or collapse, you'll see these spreads begin to spike very, very high. You see these last three recessions, look at what the high yield spread, and this is the spread between high yield debt and the US Treasury on a 10-year basis. And you can see the high yield spreads began to rise quite notably right before the recession. We had this spike here over the last couple of years that I talked about a lot in here. A lot of that was energy. When oil prices got down very, very low, there was a lot of concern about those marginal producers. They were high yield bond issuers, and were they going to be able to make those interest payments? A lot of them didn't, and so forth. So we had a real spike in that high yield credit spread, which created some concern. However, when we took energy out of the mix, it was better, but notice how it looks lately. There's virtually no concerns or no fears right now when the slope is that way from a high yield credit spread perspective. Probably my favorite recession indicator, and this would be the favorite of many economists, would be the yield curve. This is the difference between the yield on the 2-year Treasury note and the 10-year Treasury bond. We haven't had a recession in, seems like forever, where the yield curve hasn't first inverted along the way, where actually the 2-year yield goes higher than the 10-year yield. Essentially, the way the money flows and creates that dynamic says very pessimistic things about the outlook for the economy going forward. So as you can see, before these recessions, you see the yield curve invert, where the 2-year went higher than the 10-year in terms of the yield. Even these two back-to-back ones, the yield curve inverted before we had the next recession. And you can see we went along, there it inverted, there we had a recession. There it began to invert. And you can see here it came out of it. It doesn't necessarily follow the first one, but you don't seem to have a recession until at some point before you get an inversion in the yield curve. And as you can see, it began sloping down. And some people were saying, oh my gosh, here we go. And I wasn't. I did an illustration for you right in here. We really need to see it invert. As you can see, it's gone in the other direction of late. So that's also a very good sign for the economy, at least in the eyes of the credit markets going forward. And they are very careful, very conservative investors by nature. Let's take a look again at the market. This is the S&P 500 over the last 20 years. The blue line is the 200-day moving average. Essentially what that is the closing price every day for 200 days added together and then divided by 200. And every day we have a new one that gets added. So this shows the long-term trend in the market. And as you can see, and I could run this chart back 100 years, it's just that the lines are hard to look at when it's that long. But you notice that along the way, and here's a bull market in the mid 90s up until the tech bubble burst, you can see we had some volatility. We did dip below that 200-day moving average, but the average itself never really rolled over and began going lower. And as long as the slope was in a positive direction, we had an uptrend in the market. And as you can see, it did roll over here, and then we had that very ugly tech bubble bursting bear market, if you will. Then we came out of it and the slope went higher, it meandered around, kind of flattened out. I'm sure people were concerned around here, but not until the 200-day rolled over decidedly did we get that big bear market, worst recession since the Great Depression. We came out of it, we had it turn here, we had a correction, but then it came, sloped back up. We had it turn over again, but it wasn't sustainable to the downside. We did have a couple of 10% corrections in there. I'll tell you this, the slope today looks very good and not at all worrisome. So again, the S&P 500, if you will, and this would be the case among all the major averages, are just not discounting the next bear market, not even close. And I'm not saying there's not one coming. Anything is possible. We could positively, turn and slope down and begin the next bear market at any time. It's just that right now, with all the data we have at our disposal, we're just not getting that signal. So let me close with two other things. One would be, I just pulled this up this morning. This is the latest survey from the American Association of Individual Investors. They asked their members, what do you think 6 months out for the market? Only 25.5% right now are bullish. About 40% are neutral, and 33.7% are bearish. So you can see there's fewer people feeling good about the market, fewer people are neutral, and a lot more people are bearish. Now you look at these averages. On average, 38.5% is the bullish reading. We're a little above average in neutral, actually notably above average in neutral, but a little above average, 10% above average in bearishness. So one might think, oh my gosh, that's a bad thing. Well, actually, no, it's been a good thing historically. Here is, for the life of that average, or that survey, 1987 through 2016, where we are roughly right now, when the bullish sentiment is where it is right now, which is between 20 to 29, look what the market has done 1 month, 3 months, 6 months, and 1 year later, double-digit returns. Very interesting, and this is something that longtime clients and readers and listeners know. And I've talked about the whys, fear of losing versus fear of losing out. We should feel very comfortable when everybody else is uncomfortable, or in the words of Warren Buffett, he gets greedy when everyone else is fearful. They're pretty fearful right now. And fearful when everyone else is greedy. Look at when everybody's optimistic, or greater than 60% are. Negative returns for the market going forward. So kind of counterintuitive to some people, but again, we should feel good when everybody else doesn't, at least for the near term. So folks, that was longer than I expected, but I will leave it there for now. But my whole point today, again, was I get that there's a lot of media attention right now to the political race, a lot of scaremongering and so forth, and maybe it's legitimate. Maybe we do have some things to be afraid of, but the market, as we sit here today, certainly doesn't think that we have great risk of some collapse coming in the foreseeable future. I'll talk to you soon. Thanks again. Bye-bye.